Three stores reported this morning. All three beat. One actually sold more. Same morning, same country, same shopper walking through the door. Target, TJ Maxx, Lowe's. All three told us how the last 3 months went. All three beat what Wall Street asked for. And then their stocks went 3 different directions. Target went up, Lowe's went down. TJ Maxx dropped 5% on a good quarter. That doesn't make sense yet. By the end of this, it will. Here's what I found when I opened the actual filings. Every one of those 3 headline numbers was hiding something. Not a lie, just a piece nobody put in the headline. So we're going to do 2 things. First, find the real number behind each one, then run all 3 through every model Wall Street and the great investors actually use. Each model votes a price, we stack the votes, we see what these are worth. One rule first, the models run on today's price, not yesterday's. Not the price you wish you'd paid. And none of this is advice, it's math on public numbers.
Start with Target because Target looks incredible. Profit per share went from $2.05 to $4.11. That's double in 1 year. That's the headline everybody ran. Now here's the part that wasn't in the headline. A tariff is a tax. You pay it when you bring goods into the country. Target pays a lot of it. They sell things made overseas. This quarter, Target got some of that tax money back. $994 million back. That's about $3 for every person in America. That refund was worth $1.65 of the $4.11. So take it out. What's left is $2.46. 40 cents of every profit dollar came from a tax refund. Now $2.46 is still good. That's up 20%. More people came in the door, traffic up 3.6%. Same-day delivery grew more than 25%. The business genuinely got better, it just didn't double. And Target told you this themselves, you just had to read the guidance. They said the year lands between $9.90 and $10.90. Take the refund out and that same year is $8.25 to $9.25. One of those numbers is the company. The other one is the company plus a check. Hold that thought, we're going to value the company. Now TJ Maxx, or properly TJX, they also own Marshalls and Home Goods, the shops with the messy racks where you dig for a bargain. Their quarter was clean, no refund, no tricks, sales up 5%, $15.2 billion. Same stores sold 4% more than last year. They kept more of every dollar than last year, and they raised their forecast for the whole year. That is the best report of the 3, by a mile. The stock opened down 5%. Here's why, and it's almost funny. They said next quarter would land between $1.30 and $1.32. Wall Street wanted $1.35. Even at the very top of their own range, they were 3 cents light. 3 cents? That 3 cents wiped out about $9 billion of value in a morning. That's the whole lesson, and it's worth more than any model. The market doesn't pay you for what you just did. It pays you for what it thinks you'll do next. One more thing, and this one stopped me. The store with the messy racks is worth about $170 billion. Target is worth about $70 billion. TJ Maxx is worth 2.5 Targets. The shop you go to for a bargain is the most valuable one on this list. Then Lowe's, the hardware store. Wood, paint, kitchens. Sales went from $24 billion to $26 billion, up 8%. That looks strong. So here's the number that tells the truth. It's called comparable sales. It only counts stores that were already open a year ago. Same shops, same time last year. Did they sell more or not? Lowe's comparable sales grew 0.2%, 0.2%. That's a rounding error. It came from buying other companies. Lowe's bought a building materials supplier and a design group. Those sales get added to the total. So the company grew, the stores basically didn't. And Lowe's told you who's still spending. It's not you. Their words, pressure in do-it-yourself spending. What's holding them up is the professional, the contractor, the plumber, the builder. That's who they bought those companies to reach. The homeowner with a Saturday and a paint roller has gone quiet. And they trimmed the year, sales to the bottom of the range. Same-store sales, flat for the whole year. When a company narrows a forecast downward, that's not noise, that's a view. Put the 3 together and you get one picture of the American shopper. More people walked into Target, more people dug through the racks at TJ Maxx. Almost nobody walked into Lowe's to start a project. People are still shopping, they've just stopped fixing the house. Right now we price them. 5 ways of working out what a company is worth. Banks use some, the great investors use the others. Each one votes a number. We put every vote on the board. First one, picture the shop as a machine that prints cash. Every year it spits out a pile. You want to own the machine. So the question is simple: what would you pay today for all the cash it prints from here on? That's it. That's the model the banks live on. Money later is worth less than money now, so you shrink the faraway piles, add them up, and you get a price. This one is brutal on Lowe's and kind to TJ Maxx, because it doesn't care what happened this quarter. It cares how sure you are about year 8, and a bargain rack in a bad economy is a very sure thing. Second, forget the machine, just look next door. What do people pay for $1 of profit at the other retailers? Apply that same rate here, that's your price. It's the fastest model on the board and the laziest. We still run it because the market runs it. Third one is from a book written in 1949. Benjamin Graham taught Warren Buffett. His test was brutally simple: take what the company earns, take what its stuff is actually worth if you sold it off. Put a hard ceiling on what you're allowed to pay for both. Graham's rule calls almost every modern shop expensive. Almost every single one. That's not the model being broken. That's the model telling you how much of today's price is faith. Fourth, Peter Lynch ran the best fund of his generation on one idea: don't ask if a company is cheap. Ask if it's cheap for how fast it's growing. A shop growing 4% and a shop growing 20% should never cost the same. This is the model that has to answer our TJ Maxx problem: is it worth 2.5 targets? Last one, and this is my favorite because it flips the whole question. Stop asking what the company is worth. Ask what today's price already assumes. Buy the stock right now and you're making a promise about the future. Let's read the promise out loud. Do that to Target and something uncomfortable falls out. Today's price is sitting on this year's earnings, and this year's earnings have the refund inside them. So the price is quietly assuming that a one-off check is the new normal. It isn't. Target told us so in their own guidance. That's not a scandal, it's just a promise somebody has to keep, or not. Do it to Lowe's and the promise is bigger and simpler. Today's price assumes people start fixing their houses again, not this quarter, but soon. Every dollar of that price is a bet on when the homeowner comes back. And TJ Maxx, today's price assumes the bargain hunt never ends. That's a strange promise, because it's the one promise a bad economy keeps for you. So what are they worth? Here's how the machine answers. Instead of predicting one future, it rolls the dice on 10,000 of them. Some where shoppers keep spending, some where they stop, some where prices bite, some where the tax comes back again. Every roll prices the stock. Stack 10,000 answers and you don't get a guess, you get the shape of the future. 4 dice for these 3, how much people spend, how much the shop keeps, what borrowing costs, and where it all settles years from now. Target, run 10,000 times on the real number without the refund. TJ Maxx, 10,000 times. Watch how narrow this one is. Boring businesses make tight pictures. Tight pictures are expensive. Lowe's, 10,000 times. This one swings the widest, because Lowe's isn't really a bet on a shop. It's a bet on when houses move again. One more run, and I want to be clear about what this is. This is not a prediction, it's a stress test. We take the worst the consumer has ever gotten and we ask one question: if that happened again, where does the math land? So we drop spending the way it dropped in the bad years, and we find the floor, what the business earns at its worst, times what people pay for it at their most scared. And here's the thing that shows up every time we run this. The panic number and the earnings number disagree. That gap is where the money moved last time and the time before. One more and then the board. Walmart reports this morning. It may already have landed by the time you watch this. Walmart is bigger than these 3 put together, so here is what to look for and why it settles everything we just did. Here's what Wall Street is asking for: $187 billion of sales in 3 months. That's about $550 from every person in America in 1 quarter. And 74 cents of profit per share. Now watch this closely. Walmart itself said it would land between 72 and 74. Wall Street picked the top of Walmart's own range. You just watched what happens to a shop that misses the top of the range by 3 cents. One thing about Walmart that surprises people: Some of its fastest growing money isn't from selling you groceries, it's from selling ad space on its own website. Brands pay to be the first thing you see. That costs Walmart almost nothing. It's nearly pure profit. But the number to look for isn't the profit, it's the same store's number again. Same shops, same time last year. Wall Street wants somewhere around 3.5%. Go and check it. It takes 10 seconds and now you know what it means. Because that's the question this whole episode has been asking. If people walked out of Lowe's and went digging through the racks at TJ Maxx, they went somewhere. A lot of them went to Walmart. If Walmart's number is strong tomorrow, then this wasn't 3 companies having 3 different quarters. It was one shopper getting more careful.
Here's every model, every vote, all 3 companies on one board. Today's price, and the model's perfect price, Target, TJ Maxx, Lowe's, Chips. The models say undervalued, fairly priced, overvalued, plus 15% bans, engine computed. And notice what the models just did. They didn't reward the biggest headline. Target's headline was the biggest, and half of it was a check. They didn't punish the falling stock. TJ Maxx fell 5% on 3 cents. The models don't read headlines. That's the entire reason we run them. And if the shopper cracks, here's the floor on each scenario, not a forecast. None of this is financial advice. These are deep models built on public numbers. And every model on this board has been wrong before. That is exactly why we run all of them.